Everybody. Hope you're having a good week so far. I know it's Monday morning. Got a little break in the rain outside, so I'll take whatever kind of good news we can get these days, right? Let alone, I guess 2020 is coming to an end, so it'll only get better next year. So I just want to just jump right in and try and keep this one a little bit short today. Do have some good stuff I want to talk about, but at the same time, let's kind of keep this one a little bit light. So I'm going to start off the same way we always do, just kind of the generally, hey Jeff, how's the market? So let's just jump right in. Lockbox activity in Oregon. This is every time Jeannie and I open a door, registers lockbox hit. This tracks sort of week over week. So we're down 5% from last week. We bounced back up, week before, but here we are now, down 5%, heading into I guess what might be a little bit of our holiday slump here coming up. But if you look back at the very far left side of that graph, it puts us arguably on the same pace as last year. So not much has changed there. So, we're at least fairly consistent from prior years, which is good. To the north of the river, Vancouver, exact same thing, also down 5%, roughly arguably the same ballpark as same time last year. So bottom line, even though we've got a global pandemic, we've got people working from home, we've got people not working, we've got some new strain breaking out in the UK, and Lord knows what's happening here. Housing market is resilient. It's kind of plugging right along, and people are still out seeing houses, buying houses, selling houses. It's been an interesting kind of a year here. So we're going to kind of talk about some of those themes here coming up now of what's happening with the market, kind of the good, the bad, the ugly. What do we think for next year? And kind of go with some things of that nature. So one chart that I saw that popped up pretty interesting, and this is for the Portland, Vancouver metro area. Basically, it's exactly that. It's a recovery index. So 100%. That's basically ground zero. That's basically where we were in January. So thus, January is zero, and then every year or every point beyond that is how is the market looking, the housing market in relation to January, the start of the year. So obviously, you see where COVID kind of kicked in, threw us for a tailspin, and it's been a long, strong recovery for the last back half of this year. So it's interesting just to see that we sort of shrugged off the pandemic fairly quickly as it relates to the housing market. Probably more so because a lot of people kind of went through that shock, not realizing what's going to happen to their jobs, followed by, okay, I'm okay, by and large, at least from a demographic standpoint of the homeowner population, and people just kind of kept plugging right along. Then you kind of combine that with mortgage rates plummeting to the floor. I can't talk today. And then people recognizing I can work from home. I want to work from home. I need a better home. I need a backyard for the kids. Parks are all closed. So it's been a surge. So I think it's going to continue for a while. We'll kind of talk through this as we kind of cruise along through the slides I've got pulled out for today. But suffice it to say that the market looks really good in Oregon. Now, one question that does come up quite a bit is all this being propped up by things such as, do we have delinquency headwinds coming? I know we've got moratoriums in place for foreclosures and evictions and all that kind of fun stuff. So what happens, how's Oregon looking? Some protections have already slept off. We know we have been seeing consistently the people doing forbearances. Those forbearance rates have been coming down in terms of the number of outstanding mortgages under forbearance. Those rates are on the way down, so that's kind of a good news thing here, right? So as you see on this headline from Black Knight, which is an analytical firm, the delinquencies are improving, even through November, but we still have $2.2 million or 2.2 million mortgages that are quote unquote seriously past due. So should we be concerned? Well, the good news is that same study put out sort of the top 5, if you will, of worst metro markets in terms of the highest percentage of delinquent mortgages. They also put out the bottom 5, and there's Oregon at the bottom 5. So at 4.3%. So we're in the bottom 5 of the nation. So we're looking pretty good here. So I'm not overly concerned. So will there be an impact from foreclosures and such as a result of all this? There'll be some, but at 4.3%, you're not going to move the needle in terms of what's really happening in the Portland metro area as it relates to inventory and prices and all that kind of fun stuff. So it's there. And just because we've got 4.3% doesn't mean that they're all going to crash and burn. Some people will work through that. So let's just kind of keep an eye on that and let's see what happens. Other headlines kind of popping out this week. No big surprise. Hey, home flippers are making the biggest profits ever. Well, yes, when you've got prices are kind of doing this number, if you can buy smart and do a good job fixing it up, yeah, you're going to make more money. Fewer people are doing it, and arguably, here's your surprise plot twist of the article. It's because they have a hard time finding houses that are priced right for them to be able to jump in at a low price point to do this. So, the flippers are flipping. They're always going to do it. It is getting harder. It is slowing down to an extent. So we'll just kind of keep an eye on that, have to see what happens. So as we start thinking now a little bit about kind of what's to come, whether it's next year, next 2 years, kind of further down the road, this is the big headline that's going to dominate the news for a while, right? The Fed is committing to keeping buying back the bonds, keeping treasury rates low, keeping interest rates are low, and then as sort of a causal effect, mortgage rates are going to stay low until we get back to full employment. I think they're targeting a 2% inflation rate before they start raising federal fund rates. So we're a ways off. So whether we've got 2 years, 3 years of kind of borderline ridiculous mortgage rates, we'll see. We will get into that a little bit. We got some prediction slides coming up from a variety of sources, so we'll get into that here in a little bit. But suffice it to say, we've got the full backing of the government saying we need to keep rates low. We need to do everything we can to kind of keep the economy fully recovering. Step one obviously is getting vaccines rolled out, getting COVID under control or destroyed. I'd like to think we're getting to a point where we can just remove that word from our vernacular, but till we're there, we're not there. But that's the target is we need to keep the gas pedal down until the economy's up and surging, and leave things rolling. So I also I kind of appreciate this because it does relate to housing quite a bit. 2019, 6% of our workforce was working from home. 2020 kind of so far we're up to 21% kind of on average. I'd be curious to see what does that look like now, right? Because it's going to be sort of that full year to date kind of a look. And so you had the first portion of the year of normalcy. So it's this is show me this number for the last 6 months, and I bet you it's going to be significantly higher. That said, 18% is what they're predicting is going to be working from home starting next year, down to 12% in 2022. Personally, I think this number is going to stay a little higher, or if 12%, may in this case be talking about full-time 100% working from home, in which case probably a realistic number. I think that number grows if you can start factoring in the hybrid approach, right, which is going to be people doing, say, 2 days in, 3 days out, or vice versa, some combination of work from home, work from the office, checking in, and just going more hotel space on your work surroundings. So that's going to, as we continue to see more people wanting to work from home or able to work from home, it's just going to be more pressure on the housing market, because obviously they're going to need the right style of house to be able to accommodate that. They need a quiet, dedicated space, especially if you factor in what if this comes back again next year, 2 years from now, 3 years from now, and my kids are doing school from home again. We need that ability for everybody to work functionally from home. So, we'll see what happens. Here's the big piece. I think that if you want to think about, you always hear me talking about with housing, supply and demand, right? And we know the supply is it's non-existent in Portland. We had 1 month of inventory as of November, the lowest ever, down from our lowest ever, which is down from the lowest ever. So there's just no homes. And so let's think about sort of what's to come, what's going to make it better, right? You either increase your supply, you taper off your demand, and with the urban growth boundary and such, increasing our supply in a meaningful way gets, I think, challenging. So do we have a curtailing of demand? We know mortgage rates are going to stick around for a few years. So what else? Well, here you go. It's your demographic push from your age population. So in this, you've got your red line is people aged 20 to 29, and you see sort of that you've had that growth for a number of years. And where those arrows are kind of pointing up and down, that's pretty much where we are at today. So kind of to the right of that is your forward-looking projections. So your 20 to 29 demographic, steady, slowly increasing kind of down the road. And keep in mind, 20 to 29, you're not buying houses by and large. So it's the blue bar that you want to look at, and that's got a few years coming up of a hard, steep run-up, followed by then just sort of more of a consistent trend line. Hey guys, I'm online. Speaking of pressures of working from home. So that 30 to 39, those are your home buyers. That population is going to be growing significantly for the next few years, and then kind of consistently there on out. So that's going to be sort of that continued pressure on wholesale demand for houses. So, all right, what are you gonna do? All right, so all these things kind of boils down to, and I think this guy did a great synopsis here of, and hopefully you can read this of what does this mean for inventory. He's talking about inventory for specifically for next year, right? We're going to see a few things, and I think most of these things are talking about kind of the second half of next year, because I think the first half is going to be somewhat status quo. So as you think about the second half of the year, you're going to have more sellers that are coming out. They're going to be more comfortable having people come to their home. We're going to have vaccines rolled out, numbers, knock on wood, are going to be way down. So they're going to feel really good about that. I think the flip side, the counter argument of that is you're going to have more buyers coming out too, who suddenly now you have buyers saying, I'm now willing to go into other people's homes more comfortably. And so I think the sellers will outpace the buyers, but we'll see what happens. He's calling for the moving away from dense cities to stop. He's basically saying people moved away from the dense cities, whether it's Manhattan, San Francisco, places like that, because when you've got the shutdowns, there's no bars, there's no restaurants, there's no nightlife. The appeal to living in the dense city is gone, and that hurdle now is going to go away at some point, back half of next year, to allow more people then to feel comfortable living in those more dense areas. The demographics, and this is one we just talked about. You've got a lot of good headwinds or tailwinds coming in for a large population coming in. Mortgage rates, we're going to talk about this here in a couple of slides. Mortgage rates are going to be kind of close to bottoming out, starting to looking to increase at some point during the year. So as those mortgage rates start to raise up, that'll kind of cool off some of the frenzy of the housing market, which will allow that inventory level to increase a fair bit. Home builders are continuing to build as much as they can. New housing starts are up. We've talked about Portland 1,000 times. We'll see how much we can build, when and where. But basically saying, bottom line, inventory is probably going to increase. Probably really won't be meaningful until the back half of next year. And there's a lot of moving pieces to see, will that really take effect? So with that said, the person who was putting this together basically said, there's a wide variety of what's going to happen with prices next year. We've forecast anywhere from 2% growth to 10% growth. Most of them are kind of that 5, 7, 8% range that I've been seeing. 10 is Zillow, so go figure. They're the ones who are just kind of going crazy off the reservation from everybody else. 2% I think is comically low, but these are also on national averages. So we'll see what happens next year. We shared last week. National Association of Realtors had put out their forecast, and I think they're calling for 8% next year is sort of their anticipation, and then 5% the year after that. So, we will see what happens. As it does relate to some other people that put out some forecasts here, I thought these were kind of interesting. National Association of Home Builders put out these, and I've highlighted in yellow just some areas that I think are interesting to watch. So kind of those first two are new home sales. And if you look kind of what's happening from 2020 to 21 to 22, it's kind of a plateauing, right? You're seeing a little bit of a building up and then just sort of plateauing, which I think is somewhat telling. But then when you kind of look at that combined with the fixed rate mortgages down below, 2020, full year average, they're predicting about 3.1 fixed rate mortgage average. 2.89 for next year, 3.11 for 2022. So the argument here is going to be, hey, next year is probably going to be, in terms of a full year basis, the bottoming out of the mortgage market, followed by uplift. So if you want to read that as the tea leaves as they were, you're probably looking the first 6 months of next year as being the bottoming out. Back half of the year, we're going to start picking things up again. So if you're thinking about buying, you're thinking about selling, just keep in mind, I think first half of next year is going to be a super busy year with a lot of things to positively support prices and activity. So just time that appropriately. Back half of the year, yes, some things may slow down. They're also going to be that much more expensive. And now your mortgage rates may be lifting up too. So just something to keep in mind. And then lastly, we're under 15 minutes. We're on a record here. Fannie Mae, they did their own set of forecasts, and I kind of condensed their charts down just to kind of show the full years. And same kind of thing. The existing single family home sales, where I circled that first one, 5,792, 2.7% increase. followed by 2022. You're starting to see some declines in terms of the percentage change. You see a little bit of the same kind of thing. Here's your plateau point. You go from almost 5,800 to 5,600 in 2022. Mortgage rates, they're 3.1. There's your average again there. They're predicting 2.7 as a full year average for next year, 2.9 the year after that. So again, it's the bottoming of the trough, running back up again. So again, timing is going to be everything as it relates to inventory. Inventory is going to drive your prices. So we all just have to kind of see what happens. But that's your market update in a nutshell. I'm 5 minutes faster than typical here. So hope everybody has a great week. Have a very safe, very Merry Christmas. If you are getting together with anybody, please be safe. Make sure it's in a bubble. Otherwise, enjoy your Zoom Christmases and be safe. And we'll talk to you guys soon. All right. Take care. Bye.